Let's have a quick chat about it all with Michelle Schneider. She's, of course, Managing Director at Market Gauge Group. Michelle, it's always great to get your focus on days such as this. The tea leaves are so mixed. Some saying, oh, look, Charles Evans is sort of signaling that we're going to have a gentler incline. On the other side of it, they're saying, well, we're still going to go maybe 50 to 75 basis points in September. Where do you fall on the Fed?
Well, this is really actually a great illustration of just how difficult the economic conditions are for the Federal Reserve right now to actually inflict any kind of monetary policy and stick to the plan. Powell himself, right? What did he say last week? We're going to make our decisions based on the data points. So coming into today, it seemed like we were going to be at risk of a sell-off in the markets because actually the long bonds and the yields, the long bonds were rising while the yields were falling, and there was a threat of it starting to outperform the SPY, which is a flight to safety in an area that hasn't been very safe, obviously, bonds. Then coming into today with Evans and, of course, the initial morning scare, but now with Evans coming out and others saying, no. We're still really focused on inflation. Now we have the situation where the markets get spooked because the rates go up. And at the same time, of course, we have the recession, technical recession going on. So what we have here, stagflation. And historically, it is the most difficult thing for the Fed to be able to regulate. Squeeze too hard, market drops, economy drops. Go too soft, inflation goes out of control. And this is really where we're going to stay for a while. And that is exactly what we've talked about so often is the best parallel. 1970s, where we had these gyrations, the market went up, market went down, but basically flatlined until to the point really where the Fed was accommodative, stopped doing anything, and then of course until Volcker.
And so, Michelle, stagflation, it's difficult for the Fed, it's difficult for investors too. And if we're going to stay here for a while, like you say, I mean, how do you structure a portfolio around that? What actually performs well in that environment?
Well, that's a really good question, Katie, because it has been frustrating for investors. But for traders, there's actually been a great opportunity. So in this type of environment, you want to look at a mean reversion type setup, which really means exactly what we've seen. When you get sort of an extreme sell-off, that's a really good time to wait for things to settle and flip around where you have the best risk, where you know right away you're wrong, and buy. And also conversely would be on the sell side, once you get a really decent rally, particularly if you can support it with some technical resistance, like we see, let's say at 417 in the SPY, that's a good time to either take profits on your longs or go short. And in between, in the chop, unless you really want to be an active trader, you kind of have to stand back. Now, longer term, there are things that could perform with all the geopolitical risks. Gold has really been trying to find some kind of footing. It keeps also volatile with the dollar and the interest rates. But if anything comes to really start to really go badly, like China, Taiwan, or Middle East, or Ukraine picks up again, or whatever that is, you want to maybe look at precious metals. Otherwise, kind of stay safe with utilities, maybe some biotech, maybe some staples, and also take a look at oil, because if oil gets through $110 a barrel, we'll probably see another spike there as well.
Do bonds fall into that category too?
I like to use bonds as more of information. So like I like to look at, let's say, the junk bonds, because that's a real risk on. If bond traders are buying high yield, high debt companies, that's a good sign. They had a nice move. They're flipping down. I like to look at the long bonds, in particular, its relationship to the SPY. And even though we saw that flip where both the SPY and the bonds went down this year, if that changes at all, that's information. But I really stayed out of the bond market in terms of investment.
Michelle, really great to get you. Bonds are the tell for the now, and certainly they're the big move on the day, Michelle Schneider.